I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. Our first number this week is all about the elephant in the room, tariffs. President Trump's new tariff schedule announced so far in April will raise the average effective tariff rate on imports by a factor of 10, from about 2.6% to 27%, the highest since 1903. And that's including the 90-day pause for some of the higher reciprocal tariffs announced on April 9th. So this was based on the mix of imports we have been buying. And the Yale Budget Lab, which constructed this chart, also estimated that after Americans start substituting away from highly tariffed sources like China, the post-substitution rate might fall as low as 18.5%. But that would still be the highest average tariff rate since 1933, back when trade was shrinking during the Great Depression. So what effect will this have? For one thing, it will reduce real GDP. It's projected to reduce real GDP growth in 2025 by 1.1 percentage points and cause a permanent reduction of 0.6%. Now, so far, the effects of tariffs haven't shown up so much in hard economic data. In fact, our next number, the March inflation data, showed that inflation actually came in below expectations last month, with a surprising month-over-month decline in the price level and a cool down in the year-over-year growth rate down to 2.4%. That is good news because it helps give the Fed permission and room to start cutting interest rates later this year if they start to see the job market slow down. Now, one place where the effects of the tariffs have begun to appear is in forward-looking indicators, especially sentiment surveys like the Michigan Consumer Sentiment Survey. The data here shows their respondents are the gloomiest about future unemployment that they've been since 2009, in the middle of the Great Recession. And turning to the housing market, Fannie Mae's Home Purchase Sentiment Index fell in March to its lowest level in about a year and a half. So that negative sentiment is clearly kind of spreading to the housing market. In particular, the Fannie Mae's index was driven lower in large part due to respondents' fears of job loss in the next 12 months. Now, that's talking about fear of losing their own jobs. And so that is likely to cause some would-be homebuyers and sellers to hunker down and maybe press pause on buying or selling until their outlook brightens up. So, as I mentioned, that economic impact of tariffs hasn't really shown up in the hard data yet. So when we turn to how the housing market has been doing this spring, it's really most of the same story we'd been seeing last month. A rising inventory environment where we're now only 5% below March 2020 levels, and we're up 29% from the same time last year. In terms of sales activity, well, pending sales actually dipped 1.2% year over year in March. That's the first year-over-year decline we've seen in 13 months. So it suggests that housing market activity is in a bit of a holding pattern. So finally, checking in on the usual elephant in the room, mortgage rates, they are back up around 7%. The financial market turmoil in response to the tariff news briefly pushed interest rates down, but then mortgages got carried along with a surprising upswing in US bond yields. Now, that may settle back down in the coming weeks, but uncertainty really remains the watchword for pretty much all economic data this year. That is all for this week. Thank you so much for watching.